Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. WTI futures plunged 300%, completing the day at negative $37.62. It was one of many never-before-seen moments. A decade high in oil futures trading, a record high in gasoline prices. After a single crash, the industry has found a new technique to extract more money from the earth and face its greatest existential threat. Oil is no longer scarce. A chance arose 3 decades ago when the Soviet Union dropped another of its territories, disclosing a vast oil reserve. The USSR was the world's top oil producer for decades. OPEC sneered at Western producers, a consortium of large Middle Eastern, African, and South American oil producers. Meanwhile, the Caspian offered a chance for Washington to recover control of the world's most valuable resource. Poor management may strengthen OPEC, or Russia's power. So, the starter pistol went off, and the century began. They were formerly a big player, but a lack of focus and investment by the Soviet government made them obsolete. This rotation of oil executives and diplomats was meant to woo the government into doing business with them instead of their competitors. In 1994, 11 companies agreed to jointly fund, develop, and operate one of the world's most lucrative oil fields, and Auric basins have water flowing in, but evaporating out. The consortium sought alternative marketing methods because the Caspian Sea leaks connection to the ocean. Azerbaijan used to send oil by rail to the Black Sea for tanker ships. Railroads are an excellent temporary solution during pipeline construction or production booms. They use existing infrastructure and can carry oil quickly to market. Rail transports cost between $5 and $10 per barrel, more than pipeline transport. The consortium avoided building a pipeline by transporting oil from the Caspian to the Black Sea by rail. Like the railways, transporting oil from the Black Sea to the Mediterranean and beyond proved doable but inefficient. A single miscalculation might have blocked the strait for months, halting Azerbaijani oil exports. That's gone. The safest and most efficient way to transfer crude oil is through pipeline. Shipping a barrel in the US currently costs $3 to $5. These pipelines exist in the US and Canada, but bringing them online needs significant upfront expenditure. En route to Europe, a pipeline will be built across Kazakhstan. An existing pipeline used to serve Azerbaijan was reversed to transport oil north into Russia's massive network. Initially, a route through Iran was explored but quickly abandoned for geopolitical concerns, leaving the West. An expensive pipeline project began in Georgia, a country known for its geopolitical unrest and steep terrain. A consortium would have to build one of the world's longest oil pipelines, through one of the most challenging terrains ever traversed. Over 3,000 miles of roads, railways, and utility cables would have to be traversed over 3 nations. The consortium was ready to sign this check, since the Caspian oil had enormous economic potential. The organization shares scale. Its members provide 40% of global supply and nearly 80% of proven reserves. OPEC is a global cartel whose organization and geological advantages have proven difficult to overcome. OPEC emphasizes that the price per barrel is not directly related to production costs. In 2016, WTI crude prices plummeted below $40 per barrel, forcing OPEC to break precedent and invite Russia into OPEC+. Armchairs in Iran and Iraq are $10. In addition to nation-state cartels, the supply side is influenced by investor confidence, geopolitical rivalries, and political bickering. The fact that cars run on gasoline rather than crude oil further confuses the issue of why gas prices rose in 2022. Making gas from oil involves several steps, each with its own costs. Let's imagine millions of barrels made it from Kuwait to Valero's maritime terminal in Los Angeles. It's boiled in distilling towers, then separated by boiling point. Petrol has the lowest boiling point and produces propane, while asphalt has the highest. The oil and refinery architecture differ in each facility, but on average, each barrel of oil produces 19 gallons or 72 liters of vehicle-grade gasoline. That means roughly 45% of the petroleum shipped into Valero's Wilmington towers will be gas. This step alone accounts for 18% of gasoline prices. Gasoline is swapped and blended with other chemicals like butane and ethanol before being delivered to gas stations. A 100-mile radius is likely for gasoline produced near Los Angeles port, given the massive demand in Southern California. Local refineries don't offer local discounts, as any Californian would tell you. While its favorable topography explains its key ports, it also explains why only tankers service the state. California is a virtual energy island, with expensive rail shipments from the Bakken and unpopular pipeline construction. California's gas is more expensive than Hawaii's. Whether in California or not, fuel taxes account for 11% of national averages. While there are variables that affect prices from state to state or country to country, they are usually used as scapegoats by national politicians, because these features rarely change. Oil accounts for 59% of the price at the pump. It shows 24 years of global liquid fuel output and consumption. Globally, the world generates nearly as much gasoline as it uses. In 2007, prices surged when the supply line slid below the demand line. As a result of the spike in supply, the time highlighted the strength of supply and demand in oil and gas. Because demand is rigid, small changes in supply result in big price adjustments. OPEC, with its unique ability to stifle demand, recognized this. It was rapidly undone by the 2008 financial crisis, though prices gradually rose to an acceptable level for oil companies in early 2010. But in North America, innovators were creating the greatest oil revolutions ever. Shale is a thick rock. Unlike the sand or limestone that usually holds oil, this rock's hydrocarbons can't flow easily out of it. This fact has long impacted the attitude of oil and gas executives, who view the vast untapped oil resources hidden in shale as profitable. With high-pressure fluid injection and deep boreholes, fracking creates fissures in the rock from which oil and gas flow freely. Because of this, the cost of producing shale became competitive, launching the shale revolution. Unlike much of the rest of the globe, oil and gas deposits beneath the earth in the US are normally owned by the landowner, making the process of obtaining drilling rights significantly less centralized and state-controlled. These areas all had a gold rush-like boom in early 2010 as fracking spread. With a population of 14,000, Williston, North Dakota has doubled in 4 years. Americans flocked to claim six-figure salaries but confronted rents higher than Manhattan or San Francisco. The sector is booming, and everyone from waiters to bartenders to cashiers to landowner farmers are benefiting. A fracking rig was significantly cheaper to build than an offshore oil rig. The break-even price for shale oil was far greater than other production methods, such as small independent operators rather than Shell or Chevron. These small independent operators couldn't affect oil prices individually, but flooded the market. Operators were willing to give up a short-term income to obtain long-term market share. The supply surplus contributed to the 2015 crisis. That's it. OPEC and the West's large corporations have. Analysts began to worry if OPEC was doomed due to abundant oil and buyers seeking supplies. Because it was hardly successful during the decade, the cartel was only as good as its members' faith. A chance arrived when hostile oil prices followed the industry's most significant dip. Operators globally, including US shale firms, cut back. OPEC restored supplies slowly, slower than demand, and the market saw its most significant supply-demand gap since 2008. OPEC regained market control and was blamed for high gas prices. Typically, this money would go into new rig development, but now it's profit. Companies can generate more, and the US Bureau of Land Management has 9,000 approved but unused drilling permits on file. It's the same across industries. Mobil, Shell, Chevron are all investing in the present, not the future. This is not a bad strategy. The energy sector, which is virtually entirely made up of oil and gas companies, has been the S&P 500's worst performer since 2007. During that time period, the sector only gained 41.7%, meaning it was level with inflation. Unsurprisingly, the oil and gas industry lacks outside or internal investment. Peak oil is arguable, but peak oil investments are a lot easier to claim. When the globe looked like this, and we just knew of rising oil demand, investing $5.5 billion in a single pipeline made sense. Investing tens of millions in a single fracking rig is risky in today's uncertain world. Hostile oil prices seem to affect CEOs and investors. In the wake of decades of scarcity and decline, supplies became the adversary. With future confidence gone, oil is under more pressure to produce money. Oil is running out, and renewables are taking over. However, the symphony can continue to play without future industry development to capture scarcity. Limiting supply and boosting renewables can keep prices high and profits consistent. To save the earth, rather than locate a cheaper energy source, keeping prices low seems rational. Surprisingly, this suggests the oil industry is giving up markets, but not easily. Oil may collapse faster than renewables due to climate change. Fuel prices will remain high unless a significant strategy adjustment occurs. Those unable or unwilling to transition will pay the price. The oil industry's end of the world party has begun for shareholders. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.